Can a combination of two simple candlestick patterns generate over 50% return in 2020 and this equity curve? Yes, it can. My name is David from Critical Trading, and in this video I'm going to share this candlestick combination with you. We will go over two candlestick patterns called Harami and Piercing Line, where I describe both of these for you in detail, combine them together and backtest them on over 18 years of price history and a combined total of 411 trades. This is a second part of my candlestick pattern series. If you haven't seen the first one, have a look at the link to the playlist I've put in the description of this video. And if these kind of videos is something that you're interested in, then consider subscribing to my channel and enable notifications by clicking the bell icon so that you actually get notified when I publish a new installment of these series. Let's start. As always, I start out by explaining the concept, in this case the first of the two candlestick patterns, so Harami. I will be conducting my tests on stocks as always, and so I will be testing the bullish version of this pattern, so the version that represents a buy signal. Let's go over the 5 rules of this pattern as indicated on the screen. Number 1. The previous candlestick is a bearish candlestick, which is a term for a candlestick that closed lower than it opened, which is why it's shown in the red color. This goes hand in hand with the second rule, which is the opposite rule. So we want to see that the current candlestick is a bullish candlestick, meaning that it closed higher than it opened. The current candle is green, meaning that it closed higher than it opened, and so the second criteria is satisfied. Next, number 3. This rule concerns the position of the current candle's closing price relative to the open of the previous candle. The criteria is that the current candle's closing price is lower than the previous candlestick's open. So the current candle's closing price is at this level, and we can see that it's lower than this level here, which is the previous candle's opening price. This vertical dashed line I've plotted on the screen then shows the distance between these two prices. Number 4, same as number 3 but relating to the opening price of the current candle. Our criteria is that the current candle's opening price is higher than the closing price of the previous candlestick. So again, open of the current candle is at this level and is visibly higher than the close of the previous candle, which is at this level. Again, the distance between these two prices is visualized by this vertical dashed line. When both rules number 3 and number 4 are satisfied, the result is that the body of the current candlestick lies within the body of the preceding candlestick. This is the final rule, rule number 5. I've put this rule here explicitly, but it would have been implied by rules number 3 and 4. So to sum this candlestick pattern, you're looking for a bullish candle that follows after a bearish candle with its body completely inside the body of the previous candle and also with gap at its opening price. Let's find this pattern on an actual chart. This chart is an ETF that tracks the Nasdaq 100, QQQ, and the chart is a daily chart. I've got an indicator pane below my price chart where the yellow line shows the Harami candlestick pattern. I've written all rules of this pattern that I've just gone through in the form of a code where these spikes visible here indicate a valid Harami pattern. The highlighted candle meets all the criteria of the Harami pattern, and so a valid buy signal got generated. Before I go over the results, a couple of things to note. I conducted the testing on daily time frames as I only trade on those, and emulated entering the following day at open rather than on close. The trading signal got generated on this highlighted day, but the actual execution I worked with in my tests was to buy at open of the following day, so at this level. The reason I'm pointing this out here is that details like these really do matter in trading. I'm not from US myself, and so waiting by the computer at the close of the US markets to see whether there is a valid signal generated or not is very impractical for me, and so when conducting my testing, I want to make sure that I take this into the account. As far as the exit is concerned, now I'm focusing only on the entry element at this stage, and so I will test a basic exit technique of closing the long position when the current close is above the previous high. A valid exit signal got generated on this day, where we can clearly see that its close is far above the high of the previous day. But again, I will execute the exit in my tests at open of the following day, meaning that the trade would have been closed at this level. The equity curve of Harami Candlestick pattern tested on daily timeframes looks as follows. I tested on 3 different ETFs, exchange traded funds that track the US stock market, namely Nasdaq, S&P 500 and Russell 3000. I tested with initial capital of $10,000, assuming trading with standard 50% margin, and included realistic trading commissions that I get myself with my broker. As far as the equity curve is concerned, this pattern definitely looks promising and worth further development. I will take it a step further shortly, but before I do that, let's have a look at the second candlestick pattern I will test for the purposes of this video. The second candlestick I tested is called piercing line. Again, since I'm conducting my tests on US equity markets, I will test the long version only, so only the version that acts as a buy signal. Piercing line shares some of its characteristics and criteria with the Harami pattern we've gone over previously. Number 1 and 2 are exactly the same, one being that the preceding candlestick is a bearish candlestick, meaning that it closed lower than it opened. Number 2 being that the current candle is a bullish candle, meaning it closed higher than it opened. Rule number 3 of the piercing line candlestick pattern is that the current candle's closing price is above the midline of the previous candlestick. Now, the midline is simply the midpoint of its body, mathematically expressed as its open plus close divided by 2. I've got this level visualized by this dashed horizontal line here. As the closing price of the current candle is at this level, the rule number 3 is satisfied. The rationale behind this rule is that if the current candle manages to close above the midline of the previous candle, market is perceived to be gaining a strong momentum up. Number 4 is the same as with the Harami pattern. We want to see that the closing price of the current candle is being lower than previous open. Again, open price of the previous candle is at this level, and I've already highlighted the closing price of the current candle in yellow. The last rule is that the open of the current candle is below the close of the previous candle. Close of the previous candle is at this level, whereas the open of the current candle is at this level. The rationale behind this rule, number 5, and rule number 3 is that the market is perceived to be very strong as it opened below the close of the previous bar, so it created a gap, but at the same time managed to make a strong reversal within the same candlestick. Having gone over all rules of the piercing line candlestick pattern, let's find it on an actual chart. This time we're looking at ETF IWM, which tracks the Russell 3000 stock index. I've got an indicator plotted below the chart with this yellow line indicating a valid piercing line candlestick pattern taking place. I will conduct the backtest of this pattern in an exact same way as I did with the previous one. The signal is generated at close of this candlestick, but the actual trade is open at the open of the following day at this particular price. The reason I'm testing with executions at open is the fact that executing your trades is far more viable in practice when you do it this way, as you don't have to sit in front of your computer at the close. When it comes to exit, again, I'm testing this pattern with a simple exit technique of closing the trade when the current day closes above the previous day's high, meaning that a valid exit signal was generated at this particular candle. Exit, same as entry, gets executed at open of the following day, so at this particular price. And the equity curve of the piercing line candlestick pattern tested on daily timeframes on 3 different ETFs that all track the US stock market looks as follows. Again, very promising and certainly worth investigating further. Initial capital of $10,000, 50% margin, trading commissions included. Now, the problem is that both candlestick patterns I tested are combined with a simple exit that generally holds the trade for a very short periods of time and results in a small average profit. This can potentially be a problem, and so I thought, what if I change the exit with an aim to catch some bigger moves and improve the average profit size? Let's have a look. This is the same Harami pattern setup I've gone over in the very beginning of this video. The setup got generated at this candle, indicated by yellow line below my price chart. The turquoise line is indicator called ATR, average true range, which measures the volatility of the market. I've got this indicator set to period 20. The exit I'm going to use instead of the one I tested before is that I will set a profit target equal to twice the size of ATR20. Similarly, I will set the basic stop loss to be of this size as well. The figure of ATR that I've just underlined is a final figure I will use for my profit target and stop loss, meaning that it's already multiplied by 2. So to explain exactly how I will conduct the test, a valid Harami candlestick pattern is generated as of close of this candlestick. As of this point, the ATR20 reading multiplied by 2 arrives at 13.83. This will be the size of my profit target and the stop loss. However, the trade will be open at the open of the following day, at this point here, at the price of 308.12, as visible in the top left corner of my screen. To set my profit target, I will take the opening price, as that's the trade price in the backtest, and add 13.83 to it, which arrives at 321.95 for the price of my profit target. This means that my profit target will be placed at this red horizontal level. Target was hit on this day. So how will both of these candlestick patterns perform when traded simultaneously using a dynamic profit target as I've just explained? Let's have a look. The bright red equity curve is the Harami and piercing line candlestick patterns combined, so traded simultaneously using a simple dynamic profit target and stop loss that's based on ATR. The equity curve looks very promising, and yet again the results positively surprise me. Let's go over some of the key figures on the backtest report. I've got a combined total of 411 trades. These were generated by trading these two candlestick patterns on daily time frames on 3 different US ETFs. QQQ, SPY and IWM. Period covered starting from 2003 up to now, and so we're definitely talking about representative sample here. The average annual return is at just over 10% with an exposure at 26%. The annual return beats the index. You can see the performance of buy and hold of the SPY to the very right side of this table, with its exposure at 100% and an average annual return of just over 8%. The exposure translates into time in the market. If you traded 2 of these candlestick patterns combined, you'd only be invested in the market with your money around 26% of time, meaning that you could employ your capital by using a different strategy in the remaining 74% of time. If you bought the SPY and held it, then obviously you would be invested the entire time, and so the exposure is at 100%. The metric that's far more important though is the maximum drawdown. If you held the SPY during the tested period, you would have to withstand over 56% drawdown, whereas by trading these 2 simple candlestick patterns on daily time frames and using 50% leverage, you would need to endure about 19% drawdown, which is very significant improvement. And lastly, let's have a look at this monthly profit table as well. The 2020, despite the major fundamental events that shook the markets worldwide, was a single best year for these 2 simple candlestick patterns, generating in excess of 50% return after the trading costs have been accounted for. So, to conclude, very promising results and very interesting trading technique to investigate and develop further. Please bear in mind that this is not to be a complete trading strategy by any means, but is nevertheless a great, solid building block for it. As always, hope that you enjoyed this video and took away inspiration for yourself from it. This is David at Critical Trading, signing out.